Welcome to the Deep Dive, your shortcut to being well-informed and finding those aha moments in the latest earnings calls.
Glad to be here.
Today, we're taking a deep dive into the Q2 fiscal 2025 results for Academy Sports plus Outdoors, ticker ASO.
ASO, right.
And this quarter presents a truly fascinating case study because, well, on one hand, we've got a narrative of clear operational wins, but on the other, a pretty significant dose of market skepticism.
Indeed. It's a classic setup, isn't it? Well, ASO announced their first positive comparable sales in years and gave us a more optimistic outlook for the back half.
Yeah, that positive comp was a big deal.
Huge. But the market's initial reaction was quite telling. We saw shares drop significantly,
Right.
highlighting really a clear disconnect between some of those qualitative improvements and the headline financial figures. It begs the question, what's the market missing? Or, what are they seeing that maybe management isn't emphasizing?
That's precisely what we're here to unpack for you. Let's get straight to the raw numbers first. Academy Sports plus Outdoors reported adjusted earnings per share of $1.94.
Gone on the vibe.
Which notably missed the FactSet consensus of $2.14.
Yeah, that's a decent miss on EPS.
And revenue came in at $1.600 billion, just shy of the $1.610 billion consensus. So, slight miss there, too.
Right, and that EPS miss was definitely the immediate focus for many investors. I mean, while revenue was up a respectable 3.3% year over year.
Which isn't bad.
Not at all. And they hit that significant milestone of positive comparable sales at plus 0.2%, their first since 2021, remember?
That's the operational win right there.
Exactly. But net income actually decreased by 12.1% year over year. Gross margin held essentially flat at 36.0%, which is solid, but the market certainly fixated on those top-line misses, particularly earnings.
That market reaction was certainly swift. Following the announcement, ASO shares saw an immediate drop. I think it was around 7% in pre-market trading.
Yep, about 7%. Closed the day down 7.56% with a really significant spike in trading volume. Big turnover.
So you have to ask, right, if we peel back the layers, does that drop truly reflect the underlying operational story, or is it more of a knee-jerk response to the headline miss?
That's the core tension we're exploring today. The market often reacts to the immediate past, the reported quarter.
Right, the rearview mirror.
Exactly. But management's commentary suggests a focus on future momentum. It's not uncommon to see this divergence, this kind of tension.
Okay, let's unpack this operational story then. Despite the earnings miss, management sounded pretty enthusiastic about their sales inflection.
They did.
Given they had a slow start to the quarter, what specifically allowed them to break that negative comparable sales streak? What were the key drivers there?
Well, what's fascinating here is that after a soft May, sales really picked up momentum. They ran positive for the last 7 weeks in the quarter.
Okay, so a strong finish.
A very strong finish. And a significant contributor to this turnaround was their e-commerce business. It grew approximately 18% year over year.
18%, wow.
Yeah. Management credited a back-to-basics approach for this success. Things like focusing on streamlining site navigation, improving order fulfillment speed.
Making it easier to buy online.
Exactly.
Yeah.
And offering a greatly expanded endless aisle assortment online, basically, giving customers access to way more products than any single physical store could stock.
Right, the online advantage.
And this strategic focus, it also translated into improved online conversion rates and a higher average order value. So it's not just traffic, it's profitable traffic, which really shows their digital efforts are gaining traction.
So e-commerce grew 18%. That's definitely a bright spot. But, in a sector where online returns can be costly and logistics are a challenge, how much of this digital growth is truly sustainable and profitable long term? Is it just top-line vanity?
That's a crucial question, always. The fact that they're seeing improved online conversion and average order value suggests it's not just about more eyeballs, but more effective, profitable engagement.
Okay.
They seem to be optimizing the back end, which is absolutely key for sustainability.
Makes sense. And beyond e-commerce, we've just broken down the sales inflection a lot from digital. But where else are they finding growth? New store openings are, the classic retailer play. How's that fitting in?
New store growth remains their #1 strategy, and they're executing on it. They opened 3 new stores in Q2 alone,
Okay.
bringing their total store count to 306 across 21 states, and they're confidently on track for 20 to 25 new openings for the full fiscal year.
So steady expansion.
Steady expansion. And we're seeing encouraging signs from the performance of their newer stores, too. Those opened in 22 and 23.
The newer vintages.
Right. These vintages, improved from low single-digit comparable sales in Q1 to mid-single digits in Q2.
Yeah.
That indicates they're maturing, they're contributing more meaningfully to the overall sales picture.
Which is exactly what you want to see from new investments. Maturation. Okay, so beyond expanding their physical footprint, I'm particularly curious about how they're maximizing the stores they already have, making existing locations more productive. What are the key innovations there, especially with new brands and technology?
Yeah, this is a critical piece of the puzzle.
Yeah.
They've aggressively expanded their assortment, adding new, highly requested brands like Jordan, Converse, Hydrojug.
Big names.
Big names definitely drive traffic. And they've broadened the reach of existing popular brands, Burlow, Ninja Coolers, Birkenstocks, getting them into more locations.
So better assortment overall.
Better, more desirable assortment. The CEO specifically called out the impact of Nike and Jordan. He said these two brands collectively are driving meaningful double-digit growth.
Double digits from Nike and Jordan alone.
That's what they said. And it's not necessarily about securing exclusive products, but rather getting access to better, more premium products and distributing that higher-end merchandise more broadly throughout their stores, basically satisfying that consumer demand.
Got it. And the tech piece.
Right. On the technology front, they completed the rollout of RFID scanners and new handheld ordering devices across all stores.
RFID finally rolled out everywhere.
Yep. And management attributes a significant improvement in inventory accuracy and in-stock rates to these tools. It helps them save the sale by fulfilling customer needs seamlessly.
How does that work exactly, saving the sale?
Well, think about it like this. You're in the store, you finally found the perfect pair of running shoes, but they don't have your size.
It happens all the time. Sale lost.
In the past, yeah, that sale was likely lost. Now, with RFID and the handhelds, the associate can instantly see if another nearby store has it or if it's in the warehouse and ship it directly to your door.
Okay, so it captures revenue they might otherwise lose.
Exactly. It's that kind of seamless experience that truly saves the sale and hopefully builds loyalty too.
Okay, makes sense. So we've covered their internal operations, e-com, new stores, existing store productivity, but no retailer exists in a vacuum, right?
Yeah.
What about the broader macroeconomic pressures, specifically tariffs? How is Academy Sports plus Outdoors navigating that perennial challenge? That can really eat into margins.
Yeah, this raises an important question about their resilience, especially in a volatile global trade environment. Management outlined a pretty comprehensive mitigation toolkit for tariffs.
A toolkit, huh? What's in it?
Well, it includes strategic tactics like vendor cost sharing, getting suppliers to absorb some of the cost,
Right.
shifting the country of origin for their products where feasible, adjusting unit buys as needed, and purposely pulling forward domestic inventory, particularly for evergreen, never out-of-stock type products, locking in pre-tariff prices.
Smart. Stocking up before prices go up.
Essentially, yes. And they also actively use pricing optimization tools to manage average unit retails, or AURs, trying to maintain their value proposition, even if costs rise.
And what's their actual exposure?
Their current exposure for private label COGS cost of goods sold, imported from various countries, is estimated to be around 6-7%. So it's manageable, but something they definitely have to actively manage with this toolkit. It's a multi-pronged defense.
Okay, 6-7% exposure and a plan to mitigate. What about the consumer side of the macro picture? Are they still seeing that trade down effect we've heard so much about across retail, or are they actually attracting different kinds of customers?
Yes, absolutely. And it's quite distinct across different income brackets, which is really interesting. Placer AI data indicates strong double-digit growth in foot traffic and market share gains from customers in the top 2 income quintiles.
So households making over $100,000 annually.
Exactly. Strong growth there. Traffic for middle-income consumers, say $50K to $100, remain flat.
Okay.
And while there's still erosion in lower-income cohorts under $50K, the pace of that decline has actually slowed compared to Q1.
So losing fewer lower-income customers than before.
Right. But crucially, the acceleration of higher-income traffic is more than offsetting the declines from lower-income consumers.
Oh, okay.
Which is a key factor contributing to their overall positive comparable sales. So they're essentially trading up in their customer base, which is generally a good sign for retailers.
That is interesting. So given these consumer shifts and maybe some cost pressures, is the promotional environment heating up? How are average unit retails evolving? Are people still willing to pay full price?
Well, the promotional environment is described as a little more promotional than last year.
Okay, so more sales.
A bit more, yeah. Reflecting the need to entice consumers. but management was clear it's not yet back to pre-pandemic levels of discounting.
Right, not fire sales everywhere.
Not yet. What's interesting, though, is that customers are showing higher take rates on promotions, meaning when there is a sale, people are jumping on it. They're actively seeking out deals.
Makes sense in this environment. What about AURs, the actual prices?
AURs were up low to mid-single digits in Q2, and management expects them to creep up into the high single to low double digits for the back half of the year.
Whoa, high single to low double-digit price increases.
That's the expectation both for Academy and for the industry as a whole. Management acknowledges this could impact demand in certain categories,
You'd think so.
but they feel their overall value proposition remains strong enough to navigate these price adjustments. It's a balancing act.
Definitely a lot to balance, attracting those higher income shoppers, managing promotions carefully, and pushing through pretty significant price increases. Looking ahead then, what's the picture for the rest of fiscal year 2025? How confident does management sound?
Well, the company actually tightened and raised the low end of its FY25 guidance.
Okay, raising the bottom end is usually a good sign.
Generally implies more confidence, yeah.
Yeah.
Sales are now projected between $6 billion and $6.265 billion. Adjusted EPS between $5.60 and $6.30.
Tighter ranges.
Exactly. Their comparable sales guidance was also narrowed to a range of -3.0% to +1.0%. Again, a more optimistic low end than before. Still allows for negative comps, but less negative than previously guided.
Right, and SG&A costs.
They anticipate SG&A deleveraging, meaning costs growing faster than sales, to moderate through the year. They expect roughly 100 basis points or 1% of deleverage for the full fiscal year.
Yeah.
So getting costs under better control relative to sales.
Okay. And timing for the rest of the year.
Management forecasts a trough in comparable sales in late September and October.
A dip.
A dip, yeah. But then followed by a significant inflection upwards into December for the crucial holiday season. So they're indicating a belief in a stronger back half, particularly late in Q4.
Okay, so that brings us to connecting the dots for you, our listener.
Yeah.
We have this really intriguing narrative, right? Operational improvements, first positive comp in years, e-com booming, new stores doing well, good brand partnerships, solid tariff plans.
A lot of green shoots.
A lot of green shoots. Yet the market reacted quite negatively, initially at least, to that earnings miss. It's a real mixed signal. Is the market simply missing the underlying strength here? Or focusing too much on that EPS number?
It really presents that classic miss but outlook up scenario. While the EPS miss likely triggered the immediate sell-off algorithms, might just trade on that headline number.
Right. The machines don't read the commentary initially.
Exactly. But the raised low-end guidance and the clear operational momentum suggest underlying strength that the market might be overlooking in the short term. Plus, the sporting goods retail sector itself seems to be stabilizing. Pure Like Dick's Sporting Goods recently reported a beat and raise.
So the industry backdrop is maybe improving a bit.
It provides a more supportive context, yeah.
Now, a key observation here is that ASO stock had actually significantly outperformed the broader market and the retail sector over the last 3 months going into the earnings. It was up over 32% compared to the SPY and XRT ETFs.
Huge run-up.
Huge run-up. However, in the last month leading up to this call, it had already started to lag its peers a bit.
Okay, so maybe some momentum fading already.
Right. So does this earnings call then represent maybe just a moment of profit-taking after that strong run, rather than a fundamental reevaluation of the company's long-term prospects?
That's a very valid perspective. Despite the market's immediate reaction, the company's multi-year strategy, expanding stores, building omni-channel, disciplined margins, that all seems intact.
The core strategy hasn't changed.
Doesn't seem like it. The effectiveness of their tariff mitigation, how consumers really react to those higher AURs we talked about, and the continued traction of their loyalty program. Those will be the crucial signals to watch in the coming quarters.
Those are the proof points.
Exactly. Those are the details that will determine if this operational story translates into sustained financial outperformance that the market eventually has to recognize.
Okay, so as we do here on the Deck Dive, we always challenge you to think beyond the headlines. Let's talk about a wild yet plausible trade idea based on what we've discussed. But remember, everyone, this is absolutely not financial advice.
Definitely not financial advice. Purely a thought experiment.
Purely for discussion.
Okay. So, given the market's immediate, sharp negative reaction to ASO's Q2 EPS miss, despite achieving that first positive comp in 4 years and management providing tighter, raised guidance.
Yeah.
we could be looking at an overreaction, right? Driven by that short-term focus we mentioned.
Okay, so the thesis is simple. The market is being myopic. It's focusing on a backward-looking miss while maybe ignoring the forward-looking operational momentum.
Potentially, yeah.
ASO seems to be at an inflection point. They've shown effective execution accelerating e-com, new stores gaining traction, strong brand partnerships like Jordan driving that double-digit growth. Their tariff mitigation plan sounds comprehensive, and they've got strong traffic from higher-income consumers seeking value. It suggests some resilience.
So the play could be a tactical, contrarian long position on ASO.
Going against the grain.
Exactly. Betting that the market will quickly reevaluate ASO's value proposition as these positive operational trends hopefully continue into Q3. This is especially relevant given, as we noted, last year's softer comparable sales in late September and October.
Ah, the easier comps coming up.
Right. It could provide an easier hurdle for the company to beat in the coming months, potentially surprising the market positively.
Okay, so what would be the catalyst for this theoretical rebound?
Continued execution, primarily, showing that the tariff mitigation is largely offsetting impacts, demonstrating that their value approach does resonate, even as AURs creep higher.
Seeing those Q3 comps come in strong, especially against those easier comparisons.
That would be key. You'd be looking for, a quick snapback in the stock price, perhaps towards the low $50 range, maybe even higher, as sentiment catches up to what seems to be improving underlying business momentum.
Interesting thought experiment. Again, not advice.
Absolutely not.
So let's recap. Academy Sports Plus Outdoors delivered a Q2 that operationally showed strong progress. Pivotal return to positive comparable sales, driven by e-commerce, new stores, strategic brand enhancements.
A lot ticking in the right direction operationally.
But an EPS miss and ongoing concerns about tariffs and SG&A headwinds led to that significant immediate market sell-off.
Right. The narrative is really one of a company executing its strategy, showing real tangible progress beneath the surface of those headline numbers.
Yeah.
The question for you, the informed learner, is, will this operational momentum be enough to overcome the macro pressures and the market's skepticism? Or is the market rightly pricing in continued headwinds that are just too strong to ignore?
What truly stands out here, I think, is that divergence. The market's immediate negative reaction versus management's quiet confidence in their strategy. Will the green shoots blossom into a full recovery? Or are there deeper macro currents at play that the market is correctly anticipating?
That's the key question going forward.
We encourage you to dig deeper into the details, look at the trends, and form your own conclusions. Thanks for tuning in to the Deep Dive for your latest essential insights.